Mike Peltz, editor of Institutional Investor Alpha Magazine. These are the guys who put this list together. Okay, can we just talk about Steve Cohen for half a second first? $2.4 billion.
Yes.
What did he pay again? What was the settlement fee?
$1.8 billion in total.
1.8. So this was
in civil and criminal.
So this is less than a year's worth of business for him.
Yes, he could write a check for 1.8 billion and still,
Forget the legal fees.
And Dominic suggested that he's going to be off the list in the future. But why would that? I mean, he'll be off a public list, but I assume on some private list somewhere he'd be on that.
No, certainly. I mean, for our purposes, you need to be a hedge fund manager, actively managing outside money.
Does anybody do family offices yet? Is it possible to monitor family offices and their performance?
Well, like for George Soros, you could. So he used to be on the list perennially, but once he converted Soros Management to a family office, we took him off.
What's the margin for error in terms of these estimates, by the way?
We've been doing this for a long time. The writer we work with, Steve Taub, he used to be at Financial World. He's been doing this for over 20 years. And, I personally have been doing it since 2006. And we're pretty confident these estimates are accurate.
Biggest loser. We talk about all the big winners. I want to know. I want to know who was on the list last year and the year before, and now can't be found. Or at least has fallen down the list. How about that?
Well, actually, interesting. Mark Lasry, perennially on the list. This year, he's in the bottom 25.
What happened?
At 175. Just low performance.
Be careful what he just said. The bottom 25 at 175.
175.
Well, look, hold on. Where was so I saw Ackman on the list, and I'm thinking to myself, it can't have had such a great year.
Only
I saw $265 million he made last year.
Right. No, he still did pretty well.
See, this is Piketty's issue. If you got the money.
This is money he's returning to investors, right? This is money that...
No.
This is what
they're returning to their pockets. This
goes when I heard you describe it, I thought it was returning to investors.
Let's talk about what a guy like David Tepper does for $3.5 billion.
Sure.
What do you do? What did he actually physically do to earn that $3.5 billion?
Physically do? It's not like
physically do.
He's
physically
digging ditches on the side of the road.
I have a thing about this.
One thing that's important to understand is the methodology here. So part of it is based on the fees that they earn, management fees and performance fees, their percentages. The other thing is the actual return on their own capital. And so for a guy like Tepper, who's worth billions and billions of dollars, much of which is invested in his own funds, he was up 40% last year in his funds after fees.
And how did he do that? How do you go up 40% last year?
Well, one of the things he did was he made a very big bet on airlines, which had been, pretty much most people had just pushed them aside, not really thinking much about that business. And he made a big bet on airlines, auto-related stocks, financials. I mean, he's been big on equities. He's a debt guy originally. He was on the.
Where are you going with this?
Well, I like the fact that I mean, it's interesting to me that he took risk and he was rewarded, and part of it. Other is just collecting essentially a token or a toll for the fee. I look at these large numbers of amount of money collected, and if Joe were here, he had a fit, but maybe Michelle will take that role right now, which is, if I were to translate that $3.5 billion into automobiles created, where's the economic value added? Are they exacting rent from the system? Are there inefficiencies that they are closing here? What's the societal good here that they make for $3.5 billion?
Are you crazy?
Why is that crazy?
The answer.
Why is that crazy?
No, okay, the answer is arguably that hopefully most of these folks are managing money on behalf of pension funds and others and clients. So there is a societal benefit.
Right.
The flip side, if you're asking how are they able to charge these remarkable rents, we've been talking for the past 30 years about how they can charge 20%. The problem is no hedge fund.
It's not the 20%, it's the 2%, right? The 2% right off the top.
No hedge fund is going to run around and say, nobody's going to market themselves. If my marketing was, I'm cheaper than the other guy, right? I'm the Walmart. I'm the Walmart of hedge funds.
Managers, right?
That is not not an attractive way to market yourself.
And in your world, Steve, what are these guys doing? They're helping beat the fact that you can't get anything in savings, that interest rates are so low. The Federal Reserve pushes people into alternative assets in a way that. No, if interest rates were much higher, these guys would not be getting nearly the money. They would not be getting nearly the money. No way.
Steve Cohen was making a lot of money even before zero interest rate policies were in place here. And for a lot, and Tepper was making money.
But why do pension funds come out and seek these alternative assets? Because they can't do it in other ways.
But Steve's question question of why they're able to charge the rates they're able to charge, I think, is a real question.
Here's a general.
It's an issue because people
let me throw
need
out a
to make
general principle.
returns.
Throw out a
If you
general
run a
principle.
pension fund, you must make
But I think in an age
returns.
of
Higher than normal rate of return should not stand in a competitive economy. So
it should be whittled away.
It should be whittled away. That is the essence of capitalism.
You're saying that in an age where margin has been compressed on just about every business in the world, why is it not compressed in this business?
Why is it not compressed in this business?
It's the same reason why investment bankers are not compressed, because nobody walks in and says, I'm going to be the cheap alternative. For certain types of things, people say, I'm happy to give it away.
Here's my question, because I would argue that fees and hedge funds have been compressed, but not for the top earners.
Exactly.
All right. So so when you have an Appaloosa that's over the past 5 or 6 years, even through the financial crisis, has outperformed like crazy, you can charge the 2% up front and the 20% of profits. But I would argue that most hedge funds out there, especially the ones who are trying to start up, are probably only able to charge maybe 1% up front.
So this
and
is
then maybe
the winner take all.
This
is the winner take all economy here that we're talking about. Michael,
look at Tepper. His performance is remarkable. Over 21 years, he's returned after fees 29%. It's striking. That's got to be 3 times what the S&P did. It's just amazing. So that's
isn't
why.
Isn't it great that he can be rewarded for outperforming?
Right. Well, and that's why investors are willing to pay him the fees.
Mike, thank you for joining us this morning. I'm sure Mr. Piketty has put these guys up on it. He probably made this list, and it's like a dartboard for him now.
You guys know about Mr. Piketty. You write an article about Mr. Piketty every single day.
You guys in the New York Times. As Joe says, we slather ourselves in Mr. Piketty. We just rub ourselves.
Coming up, growth forecast moving higher. What will that mean for the markets and the Fed? We put that topic front and center next, and the results coming up of CNBC's Millionaires Survey. And as we head to break, check out yesterday's winners and yesterday's losers.
'Cause I'm on top of the world. Hey!